The payroll tax cut extension has been applauded by both Congress and the public.
Hooray!
But where's that money coming from?
You guessed it, from the housing industry. But it's not as bad as you might think. Where, when, and how, coming up.
Good morning. My name is Ron Morris. This is Moving Forward TV, your local real estate and mortgage update.
And I am Delynn Gaston. Thanks for joining us today. The much applauded, recently approved by Congress, payroll tax cut is actually going to increase the costs for getting an FHA loan and actually
mortgages
in general.
Now, this was kind of a backdoor tax cut.
Yes.
Now, while Congress passed a temporary tax extension that prevented Social Security from going back to 6.2, it's now at 4.2.
Right.
But that was only a temporary cut, which expires the end of February, so it's right around the corner. We'll have to wait and see what Congress does after that.
But here's how this affects you and I. Buried in the middle of this compromise is actually new increased costs for mortgages. The first thing, like we mentioned last week, Congress has actually mandated that Fannie and Freddie increase their guarantee fee,
fund.
Right, which is the fees that the lenders pay to them. And this is called a guarantee fee, and it's going to be going up. We don't know. It could be upwards in interest rate of about 0.5% or so. We're not sure. What that means, dollars and cents, rough round numbers, on a $150,000 loan, that could be upwards of about $44 a month or so to a borrower.
Okay, secondly, Congress has directed FHA to increase their monthly mortgage insurance by 0.10.
Right.
Now, let's kind of break that down a little bit. FHA charges the borrowers two ways. One, they charge an upfront mortgage insurance premium that's financed into the loan.
Right into the loan.
That's 1% of the loan amount. And just FYI, that used to be 2.25% year or so ago.
Right.
So it's drastically come down. Of course, they made it up by the monthly. The monthly today is 1.15, and again, Congress has directed FHA to raise that by 0.10, so it's going to go to 1.25. Roughly on a $150,000 loan, it's about $12 and some change a month. Not nearly as bad as some of the media sources are leading everybody to believe.
So why? Why is all of this going on? Why is this happening? Well, basically, the purpose of the MIP fund is to collect money from borrowers, and it's put into a specific reserve account.
A reserve account called Mutual Mortgage Insurance Fund.
Right. And this account is supposed to be at 2% of all of the FHA outstanding loans. And in recent years, it's fallen below the minimum 2% requirement. So this is the way that they feel that they're going to get it back up to snuff again.
However,
recently, HUD has also informed Congress that if everything stays right where it is right now, no increases or anything, status quo, it will reach its reserve requirements by the year 2014. Little overkill maybe, I don't know.
I think so. Okay, just a heads up really for the listing agents out there. If you're listing a property that's an FHA REO, in other words, it's went through the foreclosure process, HUD owns that home.
They are the seller.
They're the seller, correct. You need to have the old original FHA case number for that new buyer that comes in with an FHA loan.
Right.
If you don't, you're going to experience some delays. So as the listing agent, find that FHA case number, provide that to that new buyer so that you'll see no delay. So it's a good heads up for the listing agents out there. Okay, that's pretty much our show this week. Anybody out there that's listening, feel free to email us. I think there's a lot of that social networking stuff going on.
There
You can catch us by the Twitter and Facebook and all those items as well. And just as a reminder for the audience out there as well, Delynn and I really enjoy working with first-time buyers. So if you have some first-time buyers out there, let us know. We're great handholders with that. Been doing this for a long time and kind of keep those buyers calm for everybody.
And if you are watching us for the first time, you can subscribe right over here. And as Ron mentioned, we're out there. Forward this show out. We're on Facebook, Twitter, LinkedIn, YouTube, all of that stuff. Put it out in your social media. We are today and every day.
Moving forward, we'll see everybody next week.
Bye-bye.